How would you guys like to get paid for buying stocks cheaper than they're currently at right now? You get a couple $100s, and if a stock falls a bit, you get to buy it at that lower price. Is that a bad scenario to be in? Well, this is exactly what Warren Buffett did to become one of the richest men in the world. I bet you guys didn't know Warren Buffett is actually an options trader in disguise. Years ago, with Coca-Cola stock around $39, Warren Buffett sold 50,000 put options, which represents 5 million shares with a strike price of $35 for $1.50 per contract. He made a staggering $7.5 million immediately right there on the spot. If the stock price went up before the contracts expired, he would simply keep all of that money. If the price dropped sufficiently, he would be forced to buy Coca-Cola stock for $35 per share, a price that he liked anyways. Granted, he could have just waited to buy the stock when it dropped to $35 per share, but this way he actually got paid $7.5 million for doing nothing, just waiting for the stock to potentially fall there. Let's check out how he did that so you can learn how to do that as well and get stupid rich. Okay, so this is a strategy that I love. Selling puts is something that I do instead of buying stocks outright. As you guys know, I'm a long-term investor. I don't often do swing trades, and I'm definitely not a day trader. Although I sell puts weekly and make money doing so, my intention is to either collect the juicy premium or, worst comes to worst, as I mentioned with Warren Buffett, my intention is to actually get put the shares of stock at that strike price that I pick. That way, I get to buy a stock for less than it's currently traded at right now in the market, and I get paid for it. We're going to take a look at an example of a trade on Apple stock, and I'm going to break down how everything works visually. But first, if you haven't already, like the smash button for Uncle Henry. It's free, the button gets happy, I get happy, and it really helps out the channel. Here on my screen is Apple. It currently sits at $108.50. As a regular stock investor, if you wanted to buy 100 shares, you would have to spend $10,850 right now to buy 100 shares. Now with put selling, you still need to have money for 100 shares should the stock end at your put strike price. However, in this example, you can see that I picked a $100 price for the put option. So rather than needing to have $10,850, you only need to have $10,000 because, well, when you sell a put, you're committing yourself to purchase 100 shares, but it's at the $100 strike price. 100 times 100, we get $10,000 instead of $10,850. If you look over the premium, you can see that it says $1.62 on the screen. That actually translates into $162 since it's worth 100 shares. Okay, so a little more knowledge now. Selling puts is basically like an insurance policy. Someone would buy puts to protect their portfolio. Well, when you sell puts, you're selling insurance since that person is buying the insurance on their stocks and you're the one selling it to them, essentially ensuring that if their stocks crash or if their stocks fall, well, you're ready to purchase for a lower price. So if you want to be in an industry like insurance where Warren Buffett made billions of dollars, well, this is a similar concept, except if you like the stock that you're actually selling puts on, then you essentially have a never losing strategy since you aren't really upset when the stock falls to the strike price that you determine. And at that strike price, you're forced to purchase 100 shares. Going back to the Apple example, let's now take a look at my whiteboard. I'm gonna show you an example and discuss what the potential outcomes are of this trade and how much money you can make off this trade in terms of percentages. All right, guys, so check it out. Here's a stock investor. The current Apple price is $108.50 right here. I hope you can see that. And basically, you move up and down as a stock investor, okay? If the stock goes up $1, you make $1. If it goes down $1, you lose $1. Well, with put options, when you sell a put option, we're going for the strike price of $100. So even if Apple stock goes from $108.50 all the way down to maybe $101, well, guess what? It doesn't really matter to you as a put seller because, well, you make this premium right here, $162, okay? You make $162 no matter what, as long as Apple stays above $100. Now, if it goes below $100, you're forced to buy it, but you still haven't lost any money since you collected $162. And since this is actually 100 shares, you actually do 162, right? You take $100 and you subtract it from 162 to get $98.38. I did that math in my head. That fast too. I was always good at math. Okay, cringe. All right, so your break even is actually $98.38 because well, the price that you actually have to buy is $100 and the price that you get per contract is $1.62. You subtract, you get $98.38 and you're right here. Now, if the stock does go down to 97.38, you are losing $1 per share. All right, so think about it, guys. Basically, your break-even price is 98.38, where the stockholder, if he had gone down to 98.38, he would have lost about $10 per share. Or in this example, 10 times 100, he would have lost $1,000. Where you, YouTube family member who subscribed and likes my videos, well, you're actually not down any money. You've collected $162, and now you get to purchase Apple at an average cost of $98.38 versus purchasing Apple stock right now at $108.50, and you basically get paid for it. Now, let's talk about some downsides because, well, there's always a downside to everything, right? And basically, the only downside here is, now, the only downside is really when Apple stock, which is currently $108.50, you add in the premium that you collected, $1.62, you get $110.12. After this point, you really can't make any more money, so a stockholder who just holds stock is going to be better off than the put seller. However, like I mentioned, this is a great and phenomenal strategy for purchasing stock at a cheaper price. You get a better risk-reward ratio than just owning stock outright most of the time. However, of course, the downside is when a stock completely explodes, you do not lose money, you just lose the opportunity to make a lot of money. So if you think a stock is gonna explode, then just don't use the strategy. But if you wanna buy stocks for a cheaper price, this is a fantastic strategy since you're almost always better off than a stock investor up until the current point of the current stock price plus your premium. At that point, you would have been better off being a regular stockholder. However, this is a phenomenal strategy. Let's keep going in the video. So more often than not, selling puts will perform similar to holding stocks, and if you do it properly, you can even beat the market. I cover this and more in my weekly income options trading academy linked below. I'll now discuss different situations in which you guys would want to sell puts and show you guys 4 stocks that I would consider selling puts on right now. Number 1, you should sell puts on a stock that you wish to own point blank right now for a cheaper price. Number 2, if a stock is rising fast, let me show you what that looks like on NIO and other stocks right now. Okay guys, so taking a look at NIO, had you done a strategy for put selling, you would have literally almost never gotten put since the stock is in a massive uptrend. For the past 6 months, we've seen this stock go from $3.28 all the way to over $30. That's pretty much a 10x gain. However, if you look at the chart, we're always going up. So whenever you're selling puts, you're gonna be collecting that juicy premium over and over again weekly for the past 6 months. So that's 6 times 4, which is 24. For 24 weeks straight, you would have pretty much collected money. The only downside that I see is maybe here, had you started a position on a peak right here, you would have probably got executed the shares. But as you can tell, even when you got executed the shares, you would have been in a very good position to hold the stock and probably sell more calls to generate income at that point, which is another thing that I teach in my course. And basically, you're always going to make money on a stock that is trending higher, whether you're selling puts or you're just executing a covered call strategy. And if you want to see covered calls, there's a video right here that'll help you with that. Now, in the weeks in the middle where it's just having a lot of sideways action, you're actually performing way better than a stock investor himself because, well, the stock isn't doing so much, but you're generating income by selling puts. You can consistently sell puts at like 11, probably 11 again, $12. Basically $11 or $12, you would have made a load of money, and NIO had a very high premium because, well, options are more expensive when, you know, there's more volatility. Essentially right here, yes, you would have been kind of upset because, well, when NIO was going up, you would have made a fixed amount on your premium. However, this is a great time for me to mention, basically, if you're gonna be selling puts on stocks that you just love, absolutely love, it also makes sense to have maybe a couple shares with you. So not only do you have shares in case it just absolutely skyrockets, but also a put selling strategy to generate income. And then you can use that income to buy more shares. Does that make sense? That's a phenomenal strategy. So when would you actually want to be selling puts? Well, pretty much it's always a good time to sell puts as long as the stock is a fairly good stock. In the case of NIO, it's almost always a good option. Now, let's take a look at the second case scenario when you might want to sell puts, and I'm going to look over at Square. So basically what's happening with Square is this was amazing stock. I have a lot of shares, so I'm kind of hurting right now, but I really don't care because I bought this stock at $40 per share. I didn't buy a lot of shares, but I bought at 40, I bought more at 75. I've been buying this stock for a whole lot of time. And now what you see happening with Square is they're having a pretty big sell-off. So they peaked at around $190 per share, and now they're going down to $154. So this is a scenario where basically it's kind of like a falling knife. The stock is going down. We really don't know how far it'll go down. The volume isn't so high, to be honest. Well, there's some volume here, right? But it's not so high. And if I put an indicator on here and we look at the moving average, let's just take a look at a 30-day moving average just to get a sense Okay, so as you guys can see, it really pushed below its moving average. It might test this bottom right here at 137, or it might actually, you know, go close to 137, but not actually hit around that area, depending if there's some investors that realize that, hey, maybe this is a good opportunity to get into a long-term growing stock, Square, which Cathie Woods loves, and they're just transforming the financial sector with technology, so it's a great stock to be in. But it is falling, so what I would do here in my situation is I would go ahead and sell puts, but we don't really know when to sell puts. However, you can always sell puts around the 137 level. So what I would do is maybe I would sell a 140 put because it has some premium, and the break even between the premium and the strike price, which I just mentioned in this example, is basically gonna be around 137. So you kind of have a strategy here to buy a stock at a very low price, pretty much at a short-term bottom, which is 137, and you get to get paid for that opportunity. You really get to get paid for giving someone else insurance, for giving someone else the peace of mind that, hey, I'll protect your stock should it fall, but you get paid for that. And if worse comes to worst, you get to pick stock Square at $137. That's another case scenario where I would use put selling. Number one, on high momentum stocks, because puts are just not gonna get executed, you're gonna make money. Or number two, to get into a stock that's like a falling knife. Now I do wanna look at Tesla because a majority of my portfolio is in Tesla, and Tesla's also trending down. So what I would say here is an expensive strategy. That's why the next stock that I'm gonna go over is Bank of America, because Tesla's an expensive stock to trade puts on. Essentially you need 38 grand, and I know not everyone has 38 grand. And if you don't have 38 grand, just work hard, you'll absolutely get there. I believe in you, because you know, you work hard, you get paid for it. As long as you do it in a good way, you're helping people, you'll absolutely go there. Sorry, I just had to put that little spiel in there just because I've been working hard, and I'm hoping that I'm helping people with these videos. Anyways, with $388, you need 38 grand worth of capital, and you would sell something below $388 because you would want to purchase Tesla at a lower price than it's currently traded. So I'd probably go for something like $350. And if we actually open up the options tab within Yahoo Finance, and you look at something like November 20, which is pretty much in 19 days from now, you can do this at any time, right? You don't have to do this for November 20. If you're watching this video in the future, you can just go for December, January, or whatever time that you're watching this video. The same concepts apply. This is like a video that will just help you forever. And if you scroll down, there's a whole lot of options. Wow. Okay, let me scroll down all the way to the puts. So Tesla's around 388. We can absolutely go for like a 350 put, and take a look at that, guys. It has $11.10 worth of premium. 100 shares worth of that is $1,000. So you can get paid $1,000 in just 3 weeks, doing pretty much nothing but being ready to purchase Tesla at a lower price. What a good problem to have. You're waiting to purchase Tesla at 350, where it's currently at 388, and you're getting paid $1,100 for it. Now, last but not least, I want to talk about Bank of America, because Bank of America is another phenomenal stock. It's only $23 per share. So basically you can sell a put with only $2,000 worth of capital, because, well, 100 shares times 23 is $2,300. And Bank of America is a phenomenal stock to sell a put on because it's so low volatility. It has a lot of low volatility. It doesn't really go up and down. I mean, it tickers between like 28 down to like 23. That's not a lot of volatility, so you're pretty safe selling puts. And if you do get executed, that's totally fine, because Bank of America pays a very generous dividend. Plus, it's never really been below, what is it, like $22? I mean, we haven't really seen below $22. I mean, it's been $21 during the whole crash of March, but essentially if you sell a 22 put, you're in really good shape to get paid, plus own a stock. Not only that, but I also am pretty sure that's a very low likelihood of it going down below 22. So taking a look, it's about $41 worth of premium per 2,200 bucks. If I'm not mistaken, that's about 2% in just less than 3 weeks from now. So if you annualize that, 2% every 2 weeks is about 4% a month, or about 50% per year. And tell me, where can you find 50% per year? That's absolutely insane. So of course that does depend on this option strategy never getting executed, which you eventually will, but I end up just selling covered calls, which is called a wheel strategy, and that's what I discussed in the Weekly Options Income Academy. Is basically when you get put some stock, then you can go ahead and start selling calls to generate more income. Weekly Option Income Academy does close in 5 days, so do take advantage. The link is in the description. Thanks for watching, guys. If you want to have more information, visit investwithhenry.com. I love you guys. Either way, I hope you take advantage of this amazing strategy. I'll see you amazing people in the next video. Be aggressive in learning, but be safe in investing.
No one ever sees